Welcome to another tutorial video. This time we're going to be going over a simple example of a growth equity case study. It's not a step-by-step walkthrough. I'm going to be showing you some of the highlights here and the most important points to focus on. So for all the files and resources here, you'll want to go to mergersandacquisitions.com/growth-equity-case study. I'll pin the URL in the comments right below this video as well. This is another excerpt from our venture capital and growth equity modeling course, as you might expect. Now, if you're paying close attention, you will notice that we have covered this topic previously. We've actually covered it twice via a couple previous case studies of this software company, Atlassian. However, I don't think that these were great examples of real-life case studies in growth equity interviews because there was far too much focus on minutia, like the original issue discount and the amortization of loan fees for debt. And I don't think you're ever going to be tested on any of that in actual growth equity interviews. So in this lesson, we're going to cover the following topics. First, I'm going to talk about what to expect in a growth equity case study at a high level. Then we'll go over the historical trends in revenue for the model here. We'll look at some financial statement projections, the sources and uses schedule and the ownership, the exit calculations and the internal rate of return, and then the investment recommendation. And you can get all the timestamps on the side and skip around as you want. Let's start with what to expect in growth equity case studies. So growth equity is a mix between private equity and venture capital. One difference is that growth equity firms only tend to invest minority stakes in companies. So just minority equity stakes. Unlike private equity, they do not use debt for the most part to invest in companies. Another difference is that unlike venture capital investments, in growth equity, companies typically have to have proven markets and business models. So they have to have pretty substantial revenue, even if they're not profitable or cash flow positive yet. And then a third difference is that the companies in growth equity need to use the investment for a specific growth-oriented purpose, like market or geographic expansion, hiring more sales reps, buying more factories, maybe making acquisitions, and so on and so forth. And so if you think about case studies and interviews in these fields, with growth equity, there is a similarity with venture capital case studies in that in both, you could be asked something about the ownership or the cap table or primary versus secondary purchases, liquidation preferences, participating preferred. So both of these topics could potentially come up in both these fields. But more similar to private equity, you are very likely to get some type of three-statement model or cash flow model here as well. And then also similar to private equity, you're probably going to have to make some entry and exit assumptions and calculate the internal rate of return. And so the unique part here with growth equity is that unlike the others, you are probably going to have to do some analysis around customer level data and use that data to drive the model. In this case study specifically, you can get the PDF at the link I showed you before. This is a 90-minute growth equity case study. I have up here the finished model on screen as well. So you can get the full projections here. You can get the customer data and some data on the SaaS public company comparables. This company needs about 60 million euros of funding to implement a plan that could grow its revenue by 7-fold over 5 years. The first question is, should we invest 60 million euros at a very high valuation, about 12.5x revenue? We do get a 2x liquidation preference on that. And then should we invest another 50 million euros at a somewhat lower valuation of around 8x revenue? The second question is, what does the exit look like? Could we get to a 3x multiple or 30% IRR? That's what is laid out in the case document. And then the third question here is, what does the downside case look like? Because you always have to think about that. What if things don't go according to plan? What if the growth is slower than expected? What if it takes more money to get there? What do the numbers look like if we run into that case? Let's go into the historical trends in revenue here and talk a little bit about how to get to these numbers. Once again, I'm just going to pull up the finished version of the file to demonstrate. So if you go down here and go down to revenue and sales and marketing drivers, you see some items for new customers, upsells and price increases, churn, and you see a lot of sum if and count ifs formulas here. The basic idea here is that they give us some customer level data, which means that we need to extract a lot of these numbers from that. So in other words, they're not necessarily telling us up front what the subscription revenue numbers are. Instead, they're just giving us the subscription revenue by customer over here, and we have to use some formulas to pull this out ourselves. So for example, to count up the number of new customers in 1 year, we can use a sum ifs function. If you look at what it's doing, essentially we are taking the fiscal 2022 number and we're summing up all the revenue figures there. But if you look at the formula, we are trying to find customers where they had some positive amount in this year, but then they did not exist in the previous year. That's why we have the double quotes there for column F. So we're just using these formulas to go through and try to come up with the data on our own. Some are a little bit more complicated, like the upsell and price increase one. Some are fairly simple, like the churn one. We just look for customers that existed in the previous period that don't exist in this period. Once we have that, we can use these trends and some of the new customer estimates to forecast revenue over 5 years and calculate some common SaaS metrics like the lifetime value and the customer acquisition costs. Now, the case study document here is very helpful because on page 2, they tell us the number of new customers to expect in each year. So we can go into Excel and just plug this in right here for the number of new customers. And then we can calculate the average annual contract value per new customer and get to the revenue from new customers like that. We can calculate the price increases based on a % of the beginning revenue from subscriptions in this year. We can also calculate the churn based on that. And here, really, we're just following trends. So the churn rate seems to be going up somewhat, but then with upsells, we also seem to be getting a higher percentage here over time. So this goes up slightly over time as well. The contract values also go up. The sales and marketing spending here is also going up by some amount over time. The average customer life, we are basing this on the churn rate and just dividing by 1 over the churn rate, and then also factoring in a discount rate here of 15% because this is an earlier stage company. And so we need to reduce this customer life by a little bit. That is the basic idea of how to get to revenue here. Again, this is not a step-by-step walkthrough. I'm just showing you some of the highlights and the key points. With the financial statement projections, the income statement is pretty simple. You have the revenue and the sales and marketing. The rest can be simple percentages of revenue. Here, for example, we just link to our schedule above for the revenue. For the cost of revenue, this is just a simple percentage here based on historical trends. It's declining slightly over time. And then everything else, G&A, R&D, depreciation, these are all just simple percentages of revenue because we don't really have anything else to base them on here. And it is a quick 90-minute model. The balance sheet and cash flow statement are quite similar. Most of these items here are going to be linked to the operating expenses, if you look at the drivers up here, or to the revenue, or to some combination of both. And once again, we just follow very simple historical trends. I think the main point here is that at this stage in the model, we care mostly about the company's cash position and what it means in terms of the amount of funding they need to raise in the future. And I'm just going to bring up a partial file here that shows what happens if you have just these projections but nothing else. You can see that the company's cash balance here flips negative once we have the income statement and the balance sheet and cash flow statement projected, but we haven't linked in the funding sources or anything like that. This is obviously a problem. The cash balance cannot turn negative in real life, so we are going to need some amount of equity funding on the cash flow statement from our investment firm to prop up this company's cash balance and make sure it stays positive. Let's now go to the sources and uses and ownership here. Let's maybe go to the sources and uses first, because I think that's a little bit easier to explain. The idea here is that we have a primary share purchase and a secondary purchase. Now, the difference here is that the primary share purchase actually creates new shares in the company. The secondary purchase is just purchasing existing shares from an existing shareholder, such as one of the management team members or a co-founder or employees or something like that. In the sources and uses schedule, we want to show these separately. We also want to show the fees separately on the uses side. And then on the sources side, we are going to use some cash, some of our own investor equity to do this deal. Because again, in growth equity, you don't use debt for the most part. Firms are really investing in equity minority stakes. So the sources and uses schedule is pretty simple, but the part that's a little bit trickier is the ownership. And the issue here is that for the primary ownership for this stake, the 60 million euros that we spent here, the pre-money valuation is about 1.2 billion euros. And so to calculate the ownership, we take the amount that we invest, the 60 million, and then we divide it by the 1.2 billion plus the 60 million. So it's a standard calculation, the investment amount divided by the post-money valuation after this investment takes place. This gives us ownership of about 5%. But the secondary ownership, as I write in the slides here, is a bit different. Here, we don't add this 50 million that we invest because this 50 million doesn't actually create new shares. Instead, we're just buying existing shares that are already out there and owned by other people. So the calculation here is a bit different, and we actually get higher ownership because the valuation is lower, even though we actually invest less. We only spend about 50 million here versus 60 million here. One question you might have looking at this, if you're really paying attention, is shouldn't we change the 800 million here? Because after all, we invest the 60 million here. So shouldn't this be 860 million? And the answer is maybe. And if we do that, we do get slightly lower ownership. However, it's quite a small difference. It's a difference of maybe 0.3, 0.4%. And also the timing is unclear. If we actually buy the secondary shares first, and then we do the primary share investment, actually this calculation is fine. And we don't know the sequence of these investments, so I wouldn't worry about a point like this, to be honest, especially in a very time-pressured case study. Let's now talk about the exit calculations and the IRR here. So with the exit calculations, let's bring up the finished Excel file once again. This is pretty simple. We're going to exit based on a revenue multiple because we calculated the revenue multiples when we bought the primary shares, and also when we bought the secondary shares, we bought the secondary shares at about 8x revenue, we bought the primary shares at about 12 or 13x revenue. Now, when we did that deal initially, the growth rate here was around 120%, 117% exactly revenue-wise. And before that, it was 60%, 50%, very high numbers. By the end, the growth rates are much lower, 30%, 35%, 44%, something in that range. So of course, the revenue multiples here are going to be lower. Now, if you look at the public comps that were provided here, and you just do a sort, and you look at some of these smaller companies market cap-wise near the end, let's just do an average or look at the median revenue or something like that. Let's go up to about 5 billion market cap here. The median or the average revenue multiple is about 4.6x. And then if we take the median right here, it's about 4.8x. And then on a forward basis, it's about 4x. So this gives us a good benchmark. And I think we could make a defensible case that it should be probably something in this range, maybe 4 to 5 to 6x. We're being a little bit more optimistic here and saying 5 to 6x because our growth rates at this point do still exceed most of these comparable public companies. So that's the first part. We multiply by the exit year revenue to get the exit enterprise value, and then we subtract the net debt to get to the exit equity value right here. So very similar to an LBO model, except we're using revenue multiples rather than EBITDA multiples. Now the investor proceeds here are a little bit trickier. And if you go down to the formula, it does look a little bit intimidating at first glance, but I think if you break it down, it's actually not that difficult to understand. So I'm going to explain it in words right here. The first part, we're taking the minimum between the exit equity value and then the max between the liquidation preference and the primary ownership value. So that's what this whole part does. If the liquidation preference, the 2x liquidation preference on the 60 million that we invested, if this exceeds whatever our actual ownership stake is worth from the primary share purchase, let's just take that liquidation preference. But if it's not, then let's just take our equity stake in the company. And that's what the liquidation preference does. It provides downside protection for the investors. So that's the first part. Of course, if this is actually bigger than the exit equity value, then all we can get here is the exit equity value. So that's what the minimum part on the outside does. Now, for the second part in this, what we're saying is that if the exit equity value exceeds the liquidation preference, then we take the secondary ownership times the exit equity value. Otherwise, we say 0. And the basic point here is that if we have enough to cover that liquidation preference, then it's reasonable to assume that we get some amount of proceeds for our secondary shares right here. But if not, if this exit equity value is so low that we cannot possibly get anything for this, then we're just going to say 0. So if the exit equity value, for example, or something like 100, well, then obviously in this case, we're not going to get anything for our secondary ownership. All we're going to get is the 100 right here. Now, this is not a fully robust and flexible formula. You can break it, but for a quick 90-minute case study like this, it's fine. You can definitely find cases, though, especially at lower values, where this does not quite work as intended. So now let's go to the investment recommendation. Now, remember, we're targeting a 30% IRR and a 3x multiple. And in this base case, we're pretty close. We're at or above the 30% IRR in most of these years. The multiple ranges from 2.5x to 3.5x, but we're usually pretty close here. So in that sense, it looks good. The business metrics, such as the LTV to CAC, are in a reasonable range. They're around 3 to 4x here overall. So they're not unrealistically high, like 10x, but they're also not super low, like 1 or 2x only. 7-fold growth in about 5 years is very high, but it's not unreasonable for a software company that is performing well. Also, the fact that they are indeed losing money here. The cash balance stays negative only because of the 60 million investment that we make in the company. This is aggressive, but we don't think it is unrealistically high. And then finally, for the downside case, I always think it's interesting to look at this. So if we half the customer count, let's say each one of these, we divide them in 2, and then we just do a copy and paste as values, and we see what happens here. So let's do this. Let's also greatly reduce the exit multiples, 4, 3.5, 3. Even with this, we get to multiples that are around 1.6 to 1.8x. The IRR is now in the teens. It's between 12% and 18%. Certainly not what we wanted, but also not a complete disaster, even if this company grows much slower than expected and exits at a much lower multiple. So overall, we would say yes to this deal. It's not perfect. It's maybe not the best growth equity deal ever, but it seems like if things go well, we'll be able to get the IRR and multiple that we're targeting. And in the downside case, we don't lose money, we don't do terribly, we just fall short of the goals that we're looking for. So that's pretty much it. Let's do a quick recap and summary. What to expect in a growth equity case study. It's really a blend of a private equity and venture capital case study. Expect some cap table math, such as primary versus secondary purchases, maybe liquidation preferences. Expect a 3-statement model and some entry and exit assumptions and an IRR calculation. You normally start with the historical trends and the revenue forecast, as we did here. You often have to extract that from customer data. Then you project the income statement, balance sheet, and cash flow statement. Then you go into the sources and uses and ownership. And this is where some of the growth equity specific details come up. And then you make the exit calculations and estimate the IRR and cash on cash multiple. And then you make your investment recommendation. And you're usually looking to target specific returns in the different cases. And that's what we did here. So that's about it. Hopefully now you know a little bit more about growth equity and you have a good example of what you might reasonably expect for something like a 60, 90-minute, or 2-hour case study in an interview.